was that there is a banking crisis that is unfolding as we speak, but it's hidden from you. I don't know when it's going to become apparent. It could happen very, very soon, but you need to know about this because you need to get into proper position. It's happening. It's not something I'm waiting for. Let me show you what I'm talking about.
In her latest eye-opening video, Lynette Zang uncovers the hidden mechanics of our financial system, revealing how big banks exploit our equity for their gain. She explains the processes of hypothecation and rehypothecation, showing how banks use our assets as collateral for risky trades while avoiding legal consequences. Lynette also highlights the unique security of physical gold in this volatile landscape. This is a must-watch for anyone wanting to understand the true dynamics of our banking system and protect their financial future.
Because legally you are only the beneficial owner. So it makes it look like you own something, but you really don't. Any of these intangible instruments, assets, stocks, bonds, ETFs, mutual funds, annuities, all that stuff, you are just the beneficial owner, not the legal registered owner. So what you're looking at here is a Yale Law School study on custodial ownership. Who really owns all of these intangible assets? And you can see that it's pretty complicated in here. But this is also the reason why nobody went to jail for creating the crisis in 2007, 2008, because there's hypothecation and there's rehypothecation. And I'm going to explain that in just one little second. But what this flow chart shows you is that the big banks here are the legal registered owner of all of those intangible assets. So in court, this is exactly why no one went to jail, because they're the ones that write the contracts. They're written for their benefit, not yours. And one of the things that they can legally do is use your equity for their benefits. So between the big banks over here and all of these banks and brokerages in between, and this can be very, very long string of ownership, every single one of them gets to use your equity for their benefit and use it as collateral to borrow and then go out and take all sorts of risks and trade and do whatever they want. Here you are way down on the bottom. So if you go to court, guess what? Legally, too bad, so sad. It enables everything that I'm about to show you in the banking crisis that is unfolding right this second. Hypothecation is that legal right of the banks and the brokerages to use your equity for their benefit. Rehypothecation is, if this is done through the City of London, which most of these contracts are written in, there are no limitations to how many entities can use that same collateral and go out and gamble with your equity. And you never see it until you see it. But banks make most of their money through trading, and they do that by using your equity to borrow and trade. Now, the reality is that gold is the only financial asset that you cannot do this with physical gold in your possession. They can do it all they want with digital gold and create a whole bunch of gold that does not nor ever will exist. And how vulnerable these banks are, and the fact that they know there's going to be a bail-in. But hey, sophisticated people will be able to understand what's going on. Let me show you the scope of this problem. Synapse is one of the largest players in the banking as a service space, which allows fintech startups to offer banking services by partnering with FDIC insured banks. So when you look on all their literature, it looks like everything is FDIC insured banks. And as long as that money happens to be in the FDIC insured bank when it collapses, well, it is. But unfortunately, the documents that you signed and agreed to open up a new account give them rights in that structural ownership chart that I just showed you to do other funny things, which I'm going to show you. Okay, the company had contracts with 20 banks and 100 fintech firms serving 10 million users. That means 10 million people like you and me that could potentially be impacted by that. So let me repeat, because this is so important. 20 banks, 100 fintech firms, and 10 million end users. It is so convenient to hold everything on your phone. But when it goes bad because, hey, if you don't hold it, you don't own it. Okie dokie. These partnerships allowed companies and what they call neobanks, right, to gather deposits and advertise themselves as FDIC insured. And that gives customers a false sense of security. And I got to say this, FDIC insurance itself gives people a false sense of security. It was created back in, what year was that? 1933, during that banking crisis there where the public lost all confidence and faith in the system. So it was put in place and, hey, what do I worry about? I'm insured. Well, you are as long as they have the money. And of course, they can print as much as they want. And we've certainly seen in this past year-ish or so how they can bail out those that are chosen because they don't want you to understand that you can be bailed in. These are hidden costs that you're not aware of, but you need to be aware of. Because when you make that deposit, I don't care who it's to, you have actually loaned that entity your wealth. It's not yours anymore. You become a creditor. That's what that flow chart shows you. The bankruptcy trustee says that 85 million of customer savings is missing in this fintech meltdown. And this is not over yet. This is unfolding. The reason why you can't see it is because all those funds, the access to them is locked up. The scary part comes when they open up and they allow people to withdraw money. I don't know how long that's going to take, but I'm definitely watching it. Hypothecation and rehypothecation, which is using your equity as loan collateral. No one knows who owns or holds what because they've got 20 banks that they're working with, 100 fintech companies. This money goes here and then it goes there and it goes here and it goes there and this is used here and it's used. Can you get the picture? It is so convoluted that they can't keep track of it. Where is all of that money? Where did it go? Are they going to be able to figure this out? And how long is that going to take? Because I'm going to tell you right now, nobody's likely getting anything until they figure that out. Is that going to take a week? Is it going to take a month? Is it going to take years? I don't know. But when that happens, if people have access, would you continue to keep your money in some place that locked you out so easily? And by the way, I want you to think about this. What 10 million customers? I don't know who's lost access, but if that's where they were putting their money to pay their bills, how do you think that's going to impact not just them, but whoever they owed their money to? Can you see this snowballs? It's huge and it's scary. Shortfalls that may have existed at each partner bank and at an earlier time is not known at this time. But hey, they make an awful lot of money through that hypothecation and rehypothecation and using your equity, and you have no clue. And it's not the fintech companies that I'm talking about for the hypothecation and rehypothecation. It's your banks that I'm talking about. So this is an early warning, but I'm telling you, this banking crisis could topple the entire system. Users whose funds were pooled in a communal way known as, and I want you to write this one down, for benefit of, or FBO accounts, will have a harder time getting their money legally. So you go into a brokerage. Now look, I started in the 80s at Shearson. And at that time, it was all about pushing people to hold funds in-house. Prior to 71, most people held their stock certificates, most people held their bond certificates. In that case, if you're holding these certificates, the banks and the brokerage houses cannot use your equity for collateral. So they needed all of that gathered in-house. That's what they're talking of. Consumer News comes out and say banking with third-party apps, not our problem. FDIC deposit insurance does not protect against the insolvency or bankruptcy of a non-bank company. Fintechs are non-bank companies. They partner with banks to make them look like a bank and deceive you, but they are not banks. They do not have, and I say this tongue-in-cheek, any FDIC protection, but goodness gracious, by their own admittance, they've got a teeny bit more than a penny to support every single insured deposit, forget uninsured deposits. And so what happens if there's a bank run at 20 banks? It'll become very clear very quickly that there is a much bigger problem than you see. And if enough risk has been transferred, guess what? Like in 29, like in 1970, again in 2008, these markets will just become too expensive to support. Not for you. You are a systemically important financial individual for your family, but not for the world. The banks are for the world. That's who they're protecting. Because what about the contagion from those 20 banks, 36 fintechs, and 10 million customers? Everybody's going to be impacted by this. Are you ready?
Thank you for joining us as Lynette Zang unraveled the complex and often hidden practices of our financial system. If you found this video enlightening, make sure to like, share, and subscribe for more insights into how you can protect your financial future. Stay informed, stay empowered, and remember, in a world where banks leverage our assets, knowledge and physical gold can be your best defense. Until next time, keep your assets safe and your mind sharp.